Good evening, everyone. I'm CA Sneha Rao. I, on behalf of Women Members Empowerment Committee of ICAI, welcome you all in the Sky High Symposium Series 29. The Sky High Symposium is a Wednesday series of programs conducted by the committee for the women and by the women. It is one of the Women Members Empowerment Committee's initiative to not only to disseminate the information to our women members for upgradation of technical and non-technical skills, but also to empower and inspire women members to come at forefront and realize their verbal skills at a public forum. Today, we are going to cover two sessions on annual compliances under Companies Act 2013 and tax exemptions for startups. For our first session, we have CA Ranganayaki Rangachari ma'am, Rama ma'am with us. She is a proud member of all the three premier institutes of our field, that is ICAI, ICSI, and the Institute of Cost Accountants. Currently in practice as a chartered accountant, registered valuer, and the insolvency professional specialized in the areas of FEMA, GST, and valuation. She has a vast and varied experience of more than 20 years of working in India and China in diverse sectors of retail, offshore survey, shipping, private equity, and print media. Before setting up her practice, she worked in various corporates like Oswald Group, RPG Food World, Elcom Group of companies, General Atlantic Partners, etc. She has handled various senior level roles in all these organizations and dealt with various aspects of business, including project implementation, fundraising, direct and indirect planning and assessment, tax planning. Then FEMA compliances, FIPB approvals, group restructuring, business sales, and HR management. Besides being busy in her corporate world, she also does mentoring for students pursuing professional courses, acts as a faculty for financial, cost and management, accounting, and financial management, conducts seminars and workshops on GST, tax compliances, and corporates, acts as a trainer in finance, and is a regular speaker, a mentor for startups, a stock and market enthusiast, and also loves to travel. Hats off to you, ma'am. You do so many things together. With this, I invite CA Rama ma'am to start with the session, please. Over to you, ma'am.
Thank you, Snehal, for that wonderful introduction. Though many of them don't deserve the way you have put it forward. Thank you so much. Good evening, everyone. A warm welcome to this webinar. First, let me acknowledge thanking, Preeti ji and Shri Priya ji for giving me this wonderful opportunity to speak to all the women professionals. When we speak in various forums, it is one and the same. But when we speak among the platform of women, it feels very different, because we come with a lot of, management, things balancing and things like that. So I'm very, very happy to be in this program, a program by the women and for the women. Every, program where we speak calls for definitely certain amount of preparation and the hard work in that. But when you speak among women, I was there in a program a couple of months before where Nirmala Sitharaman ji was there. It was an entire audience of women. She said, when I start in the front of women, I speak much more than what I generally speak in a different forum. She was very candid, which we have never seen her. So that's the way when we stand in front of women, we speak as if we are speaking to each other as a close friend. So thank you for giving this opportunity. The topic given to me today is on corporate law compliances. I find a lot of women professionals practicing in various areas of professional practice. Some of us are into corporate law practice. For me, corporate law came as by default because I was working as a company secretary whenever I was there heading a finance department. The opportunity to practice in corporate law is far, far more. Especially today in a scenario, we all read in newspapers, we all read in our WhatsApp groups and other group discussion saying that today Ahmedabad registrar levied a compounding fees of 6 lakh rupees for company not quoting SIN number. for not quoting DIN number, for not appointing company secretary, for just uploading your tally balance sheets in the in your AOC4. We have to stop and think the way we do justice to our income tax return filing or GST filing. Do we give the same amount of justice to our company law practice? Now, especially, I'll start my presentation with CSE and I will end my presentation also with CSE. Let me just share my screen before I start. See, I start, when off late, whenever I speak on corporate law, I always say we have to understand the background in which the MCA works off late. Is my screen visible to everyone? Yeah, just a second. And if it is in the full screen mode, yeah. Is it visible now?
Yes, ma'am.
Yeah, okay. So the kind of compliance which is expected from a registrar everywhere is far and many. Non-compliance is not an option. So when we start about corporate law compliance, let's start with why to comply. Section 403 straight away takes that, whenever you have to file any document or any information, it has to be paid with a certain specified prescribed fee. The fee could be anywhere between 300 to 6,000, depending on a domestic company or a foreign entity. If we fail to file the forms within time, we are going to pay an additional fee. So different fees are levied for different class of compliances. So basically, if you are into section 92 or 137, 92 talks about annual return. If you fail to file it within 60 days from the AGM closure date or the day in which the AGM is supposed to be conducted, then we are going to pay 100 rupees everyday penalty. When we delay in filing our annual accounts, that is AOC4 or AOC4 CFS, there's going to be 100 rupees penalty every day. So with these background, not complying is not going to be an option at all. It's going to be an extremely expensive affair. Especially, I just started saying that off late we see, compounding orders from many registrars, especially we see from Bangalore and Ahmedabad on lot of non-compliance. In fact, in one case, they had mentioned that the professional who has certified the documentation has not seen the minutes. So corporate law compliance, whether you practice or not, when you are doing audit, it becomes very, very important to get the corporate law into control, because certain things happen in an organization. Whether the person executing those activities do have the power, whether they have exercised their power in order, needs to be understood. Is the minutes book in order? Is the registers in order? Because today, if you see the new Schedule 3 and CARO, calls for a lot of information to be provided both by the company and the chartered accountant. So to compile and collate all those data, we need to have so much importance given to the statutory documents and the documents to be maintained under Companies Act. CARO, the new CARO calls for a lot of reporting. And if you see, all those reporting has emerged from Schedule 3. So the management confirms certain things. The same thing has been, opined upon by the auditor in the same fashion, whether it is done in the same fashion or not. So in this background, we have to understand there is a CSE which is in operation off late. What is CSE? Central Scrutiny Center. So I'll start my presentation with CSE and end it with CSE. When we are in income tax, we have our CPC, which looks at our documents, sends us a notice for your intimation. Similarly, we have assessment in GST. Now, in company law, most of the forms filed are on STP mode, straight through process. So you upload, the matter is end with that. Generally, at least the automation has happened in the last few years. Before that, it was on physical form. So the scrutiny didn't happen. Now, with the new CSE in place, we have these forms scrutinized. They have got 8 years to scrutinize these forms. And if there is any deficiency found out, the department, the CSE will send to the concerned registrar. Registrar will send to us asking to refile that form. There are two things comes out of that. One is the form has to be filed afresh. The late filing fee is going to hit. The second one is the kind of wrong certification, miscertification emerges from there. So this is the background in which I'm going to start my presentation, saying that there are different penalties specified for different sections. So non-compliance or late compliance is going to be an extremely costly affair. And if you don't file it within certain date, we are going to pay an additional fees, which ranges anywhere between 3 times to 12 times and to 18 times also higher additional fee. Over and above, there is going to be a penalty levied on the company and the officer in default. So we just read a couple of weeks ago saying that 6 lakh rupees is paid for non-payment, non-quoting of DIN number, non-quoting of SIN number. These are the smallest errors which could be avoided if we exercise certain amount of caution. People not maintaining the registered office, people not filing the director's exit or induction, or additional director being converted into a regularized director. All these non-compliances are there on record. These things will come to haunt us when the company goes for valuation and go for funding, especially when we do startup due diligence. A lot of them have got non-compliance on DPT3, MSME1, or some DIN KYC. Everything is adding up to the cost. So the cost of non-compliance, again and again, I'm saying it's going to be expensive. Having said that, Section 446B says, if a company is a small company or it's a producer company or a one-person company, the penalty which is going to be levied is going to be half compared to a company which is a normal company. So we want to do help the small companies and startups to do their business without burdening with the cost of compliance or with the expense of non-compliance. So the penalty is being half there. Now, when we look at, okay, now we have said what is the background in which, what are the, why we have to comply and what are the compliances. There are various kinds of compliance, one at a procedure level and one at a form filing and approval level. At procedure level, we have what your statutory minutes to be maintained, your register to be maintained. And at form filing level, we have several forms like your AOC4, MGT7, DPT3, whatnot. So many forms are there. Failure to file even a single form is, again, I will stress, is going to be costly. So we should have a checklist of those documentation, especially when you're, because these are the things I have seen practically. A company, a foreign company which has come into India as a branch office, not registered with MCA. Today, they want to close down the branch office. RBI is asking for the documentation for, filing of documents in MCA. Not filed. The penalty or the late filing fee, if you don't file for 5 years, 10 years, is going to be expensive, highly expensive. I can't even quote the number here. So every section of company law had to be read thoroughly and action to be taken. This is a very, very huge area of practice available for professionals. It doesn't come with that kind of difficulty like GST or income tax. I'm not saying it is easy, but comparatively, the kind of amendments or the notification which comes are completely manageable to that extent. So we'll start from the beginning of the company. When the company is established, we start from the compliance. What is the first compliance? We have the first board meeting to be held within 30 days of incorporation. The bank account has to be opened. The share capital has to be put into the bank account. A Form 20A has to be filed for commencement of business. If 20A is not filed, we cannot file any other documentation with MCA. In fact, if you try to put that SIN number, it won't even allow you to file the documentation. You have to take the MOA on record, appoint an auditor within 30 days. These are the mandatory things. Yes, ADT 1 is generally not filed for the first appointment of auditors. It is done in the first AGM for the next 5 years. But having said that, ADT 1 can be filed for the first appointment also. So the company is incorporated, the first board meeting has happened. In that, the directors have to come and give their disclosure of interest. The entire corporate law, I just say, it's not only 2013 company law. The company law across the globe, even 1956, stressed only on corporate governance. The real purpose of corporate law is corporate governance. So the director or the key managerial person who's in the board has to disclose their interest. Everything has to be done in a transparent and easy fashion. So in the first board meeting, when a director attends a meeting, he or she makes a disclosure of the entities or the concern in which he or she is interested. For example, the interest is not there in the first board meeting. Maybe it happens after 2 board meetings. The board meeting, after that interest has occurred, they have to come and make a disclosure. Look, these are the companies in which I'm interested, or the proprietorship firm or partnership firm. and the disclosure has to be on record. In a public limited company, they don't even take part in the decision making, whereas in private limited company, you can disclose your interest and participate in the voting. So the challenge is, if the interest is not disclosed, then those contracts are voidable at the option of the company. So that's the challenge. Then we move to section 173. If you have any questions, you can feel free to stop me and ask any question. If the speed or the way I'm going, if it's fine, somebody can let me know. But having said that, 1 hour, we won't be able to complete everything, but I'll give you a bird's eye view of the entire compliances. So next is a meeting of the board of directors. Every company has to have at least 4 board meetings in a year. The first board meeting happens within 30 days of incorporation. And the 4 board meeting has to happen in at least in each quarter. And the gap between 2 board meetings cannot be more than 120 days. In case of a small company, OPC and dormant company, the requirement of 4 board meetings reduces to 2 board meetings. And the gap between the 2 meetings should not be less than 90 days. So in case of 120 days, it cannot be more than, whereas in case of 90 days, it cannot be less than 90 days. So the number of board meetings have to happen. When we are doing audit, whether the minutes are there on the record, if you audit a small company or a small private limited closely held company, many times the minutes are not there on record. It is our responsibility to ensure that the minutes are there, because tomorrow the directors might change. There could be some misunderstanding or whatever, discomfort between them. The resolutions which are passed may not have been, the attendance register may not be signed. So it is our responsibility at the time of audit to ask for all these statutory documents. I generally say, if your company in which you are auditing has got a secretarial audit, please go through the secretarial audit report. It is a chicken and egg situation. We will ask for the secretarial audit report. Secretarial auditor might ask for our report, but we have to work in tandem with each other so that we all are able to collaborate and get the right kind of assurance on whatever reporting we are going to make. Then next is we move to section 164.2, disclosure of non-disqualification by directors. This was a famous topic a few years before. The companies which have not filed their annual returns for more than 3 years, the registrar had suspended all the DIN numbers, and 5 years they were disqualified. So at every year, these directors have to say whether they are qualified to sit on the board of the company. When will they get disqualified? If their company in which any of the company in which is a director or she's a director has not filed the annual returns or the financial statements, or failed to repay the deposits along with interest, or failed to repay the debentures, then in that case they become disqualified to sit on the board of that company. They get 6 months to get the default, non-filing corrected, but beyond that they become disqualified. So the company, they have to give a disclosure to the company saying that they are qualified to be on the board with the form DIR-H. It becomes much more important to us because in our audit report also, we do say, based on the information given, they are qualified to sit on the board. So this disclosure has to be on record. Same is the case for a declaration by an independent director. So when an independent director comes and sits on the board, certain qualitative classes of companies do need to have a independent director. So if they have to have an independent director, even in the first meeting or in the first meeting where they get interest, they have to come and make a declaration of their independence. So what are the directors? The independent director should not be a promoter. He should not be a relative of a promoter. They should not have any pecuniary interest beyond 10%. The relative should not be holding any interest. They should not be indebted to the company. They should not be taken or given any guarantee to the company. They should not have any pecuniary transaction beyond 2% threshold. They should not be a relative of your auditors, company secretaries, consultants who have worked in the past 3 years, and they should not have more than 2% voting rights. See, all these declarations has to come from the respective people. This independent directors is applicable to listed company and public limited company having a certain threshold of turnover, net worth, and this thing. So those declarations have to be on record. The very important thing which generally misses out or we fail to take note at the time of audit is maintenance of statutory registers and minute book, the minutes of the AGM, EGM, the minutes of the board meeting, the minutes of the committee meeting if it is applicable, register of members, register of debenture holders, index of members and debenture holders, foreign register of members if it's applicable, register of renewed and duplicate share certificate. This becomes very important. Sometimes what happens, the share transfer happens, but the shares are not split. New certificates are not issued. They are not recorded on the register. So technically, the documentation is not completed. But we are confirming, saying that certain things have happened. We have seen cases where transfers have happened on paper, but technically this transfer could not have been happened because you need two members to run a company. A foreign multinational is holding. They should have one nominee shareholder. The nominee shareholding is also transferred. So such non-compliances have to be monitored very carefully. As a statutory auditor, it becomes very, very important for us to understand whether the technicality of all these corporate compliances has been taken care. Where if there is any sweat equity issue, the register of that, employee stock option given, register of securities bought back. Buyback is an area which needs a lot of scrutiny. Register of deposits, register of charges. Register of charges is a very, very important document. We can go on hours and hours for discussing that because that talks about the corporate governance. Somebody is relying on the assets of the company and lending it to that company. If the charge is not filed on time, the charge is not noted in the register, it's good because we are also going to report on all these things under our CARO. So, and the management is supposed to disclose in their Schedule 3. So these registers are very, very vital for our audit and as such a practice under corporate law. Register of directors and key managerial person, register of loans and guarantee given. This is a very, very important register. Very, very important area of scrutiny to find out whether the loans given or loans taken are within the rights and powers of the board or the powers of the company. Those things need to be understood. Register of investment, register of contracts and arrangement in which directors are interested. So these registers will form as the primary source of audit for a lot of things under a Companies Act. So these registers have to be maintained and these have to be scrutinized by us as a professional doing audit, whichever kind of audit. Then the next is the statutory form to be filed under for a director's KYC, which is DIR 3 KYC. The first form filed is a physical form. When there is any, after that, it is going to be a web KYC form. This form has to be filed before 30th of September every year. Failure to file this form within time is going to cost 5,000 rupees per director. And if there is any change in the details of a director, like an address, a phone number, or email ID, then again a physical form has to be filed, and the professional has to certify those forms. Next, move to another, latest, newly introduced form, which gets missed out in filing. Form MSME 1. Any outstanding due towards MSME enterprises, if you have any MSME enterprise to whom the payment is not made within 45 days, if the payment is delayed beyond 45 days, this form MSME 1 has to be filed. It's a half-yearly form. The period is actually April to September and October to March. The form for April to September is to be filed before 31st of October. The form for October to March has to be filed before 30th of April. In the old Companies Act, before changing the Schedule 3, the Schedule 3 said if there is a requirement under any other act, that requirement, even today it is that will override our Schedule 3. So if there is a requirement for a disclosure under, say, some act, and it is not there in Schedule 3, the requirement under that particular act will take precedence and those disclosures have to be made. So before getting the Schedule 3 was amended, this MSME reporting was done by us because of the requirement under the MSME Act. This is a form generally missed out, especially in case of startups when we do due diligence. Then DPT3, return of deposits. DPT3 is filed for return of deposits of transactions. DPT3 is a return of deposits, but transactions which are not considered as deposit also has to be reported in this particular form. So this is a file pursuant to Rule 16 of Companies Acceptance Deposit Rules 2014. This applies to all company except for a government company, a banking company, NBFC, and a housing finance company. So as I mentioned, not only the deposits are reported, even transactions which are not considered to be deposits under Rule 21C of Companies Acceptance Deposit Rules is also to be reported. What are those? I'll pick up some of the examples of transactions which are not considered as deposits. If a company has received any loan or any funding or guarantee from any government, whether it be local government or foreign government, it is not considered as a deposit. Money received as a loan or facility from banks and financial institutions or insurance companies, intercorporate deposits, loan from directors, unsecured loans, any advances received from your customer, which is overdue beyond 365 days. All these things are less than 365 days. All these things are considered as not deposit, but they have to be reported in DPT3. And the due date for filing this form is 30th of June every year for the previous year ending. Another thing, a very less known form is PAS 6. This is a share capital reconciliation audit report. This is filed by unlisted public companies. Reporting, this basically reports about the changes in the share capital. This is filed on half-yearly basis for each ISIN separately. This should be filed within 60 days from the end of the half year. And the due date is again April to September is 29th November because it is 60 days. And for October to March, it should be filed before 30th of May. This form, we are all well versed, AOC 4. The real challenge is AOC 4 is filed. Are we filing all the necessary attachment? And are we filing AOC 4 CFS if it's applicable to us? Is what is a question under this particular form. Every company requires to file its financial statement along with the consolidated financial statement, if any. So if you have a subsidiary, CFS is applicable to us. Then if you have a subsidiary, then not only AOC 4, AOC CFS should also be uploaded within 30 days of conclusion of the AGM or the last date by which the AGM has to be held. So what is the due date for holding AGM? If you are a newly incorporated company, 9 months from the end of the financial year. So if a company is incorporated in, say, January 21, for them the year ends at 31st March 22, and their AGM can be held before 31st of December 22. For the other companies, it's 6 months from the end of the financial year. So by September end, the AGM has to take place. If the AGM do not take place, still these forms have to be filed because it says the last date on which the AGM is supposed to be conducted. So unless until we seek for an extension. So categories of company which requires to be filing this, companies not requiring consolidation, they will file AOC 4. Companies requiring consolidation will file AOC 4 CFS. And you have companies filing in XPRL mode. It is applicable to certain companies like your companies listed on stock exchanges and having their Indian subsidiaries, or company having 5 crores and above capital, or having a turnover of 100 crores or above. So these people will file their forms under XBRL mode. The challenges is all the attachments of AOC 4 are attached while filing the form. What are the attachments which should be done? Copy of the financial statement duly authenticated as per section 134. That means there should be a board report, there should be an auditor report, there should be accounts, accounting policy, notes to accounts, everything has to be there. If we fail to attach accounting policy, we are failing to fulfill the accounting standards. AS1 says accounting policies have to be there. So if you fail to follow, AS2, 3, 4 and not file AS1, you are failing on 2 accounting standards, 1 and 2 or 1 and 3. So the accounting policies and the standards have to be uploaded. Has to be a part of the financial statement. Statement of subsidiaries. If they have a subsidiary, it has to be filed. The statement has to be filed along with AOC 41. In case the AGM is not held or the accounts are not adopted in the AGM, then the fact that it is not adopted and the reasons for not adopting the financial statement in the AGM. Statement of the fact and the reasons for not holding AGM. If AGM is not held, why it is not held? That statement has to be there. or the reasoning has to be there. In case the extension has come, the approval letter for the extension has to be uploaded. Company CSR policy. CSR is again a very important area of practice, huge area of scope of practice. Details of other entities, and then related party transactions in form of AOC2. If you are a public limited company or a company coming under CAG audit, then the comments of CAG, secretarial audit report if it's part of the requirement to get the secretarial audit report done, director's statement, director's report, details of remaining CSR activities if anything, and any other optional attachment has to be filed. This is as far as the financial statement is concerned. Mostly we are aware of it because it's a part of our function. It's a part of our extended audit function. The next form which needs to be filed is MGT7 or MGT7A from last year for small and OTCs. This MGT7A has come in. The form is slightly smaller and has got little lesser data compared to MGT7. So this is an annual written form. This has to be filed within 60 days of the conclusion of AGM. And now we have MGT7A also. So this was introduced for 2021 onwards. We have to have the ISIN of equity shares to be mentioned in the table of share capital. In case we have name and addresses and countries of incorporation registration, if we have all these information kept abroad. There is another form called MGT8. This is actually certification of annual return. So under section 92.2, read with rule number 11.2 of the company's management and administration rules, in case of listed companies and having and a public limited company having a capital of 10 crore or more, or having a turnover of 50 crores or more, is required to file an annual return certified by the company secretary in form MGT8 attached with this annual return. So that needs to be ensured it is filed along with our annual return. In case of under section 121, in case of public listed public companies, they have to prepare a report that the AGM has been conducted and it is it was convened, held and conducted as per the procedure in form e-form MGT 50. This is again has to be filed within 30 days of AGM. ADT1, we are all very familiar. This is our bread and butter, day in, day out activity. In case auditor is appointed for 5 years tenure, that is till the 6th AGM, and thereon for every 5 years. In both the cases, whether it is the first AGM or after that, the ADT two cost auditors. The way we have ADT1, there is a CRA form. When a cost audit shall be conducted, cost audit always conducted by a cost accountant in practice. The cost accountant is appointed by the board on a remuneration to be determined by to be filed within 30 days of appointment, or if there is a change in the appointment, within 30 days of change in the appointment. So cost audit is applicable for companies which are specified in item A and item B of Rule 3 of company cost audit records and audit rules. So generally it applies to companies generating electricity or certain specific manufacturing companies, and their turnover is more than 35 crores or more in the preceding financial year. So if they fulfill that criterion, cost auditor has to be appointed, and the cost auditor appointment is filed in CRA2. Then CRA4 is filed. It's a report of cost auditors. So cost audit report is filed under section 148(6). For filing cost audit report with the central government, the form is CRA4. This is again to be filed within 30 days from the receipt of the copy of the cost audit report. Here, the AGM is not the criterion. 30 days from the date of receipt of cost audit report. So I just mentioned cost audit is applicable for certain type of companies like electricity generation and other crucial sectors where they might be in manufacturing or services also, where it is crucial, where the cost is a major determining factor or It cannot be increased left, right, and center. So it applies to those companies having a turnover of more than 35 crores. Then next is a secretarial audit report. This is filed in form of MR3. So secretarial audit is conducted as per section 201 of the Companies Act. So it applies to every listed company, every public company having a paid up share capital of 50 crores or more, every public limited company having a turnover of 250 crores or more, or every company having outstanding loans and borrowings from banks or financial institutions having more than 100 crores or more. I always say when there is a secretarial audit, it becomes easy for us to conduct a statutory audit. In the sense, the secretarial auditor takes certain part of the work. It is whole and soul work of them. If there is any violation or if there is any non-compliance, it can be discussed with them, and it becomes easy for us to get our CARO reports and Schedule 3 compliances in order. So before we issue our final report, if we can sit with the secretarial auditor and discuss their observation with our observation, it will supplement and complement each other's work. That is very, very important, especially today with numerous compliances. It becomes next to impossible for me to practice alone. We have to have a collaboration. We have to have people to whom we can look up to for guidance and for knowledge sharing. So that's where this becomes very important. The next statutory form which needs to be filed is MR1. MR1 is for appointment and reappointment of KMPs, for managing director, holding manager. So this is to be filed within 60 days of appointment. This is done under section 196. The form is MR1, and this is applicable to all listed company and public limited companies. We are very familiar with this form, DIR 12, for the appointment and resignation of directors. It has to be filed within 30 days of appointment or resignation. It applies to all forms of companies, and this is filed under section 149. I would just like to add one thing here. When a director is appointed by the board, they are appointed as additional director. Their appointment has to be confirmed in the coming AGM. So after the AGM, if you don't file this DIR 12 again, you will find that title always an additional director. So in such cases, DIR 12 has to be filed with a change of designation. So that is something is missed out when we do due diligence. This is what comes to our observation. Statutory forms to be filed under corporate social responsibility. It's a huge topic for discussion. I can't even complete it in a hour's time. And there's so many changes. And there are penalties for not complying with the CSR guidelines. So whom does CSR applicable? For companies having 500 crores or more net worth, having a turnover of more than 1,000 crores and above, and average net profit of 5 crores and above. So generally, if you see, very few companies get hit by this 500 crores and 1,000 crores. But most of the companies, many of the companies get hit by this 5 crores threshold limit of net profit. So it becomes applicable for a lot of companies. So if we are hit by any of these things, we have to spend average 2% of the net profits and do the CSR activities. So if you have a CSR liability of up to 50 lakhs, then there is no requirement to have a CSR committee set up. Then for the companies we spend any amount in excess of CSR obligation, that can be set off against obligations in the future financial year. This is not the case in case of a trust and charitable institution in say utilization of fund. If you spend more than 100%, you don't get the benefit in the future years, but that benefit is available under CSR activity. When excess spending is done, it can be set off against the future years. The challenge here is, if we don't do it within time, the penalty is going to be twice the amount which is to be spent or the amount to be transferred to a fund. So if we are unable to do a CSR activity, we have to transfer the funds to the fund specified under Schedule 7 or the unspent CSR amount as maybe or by 1 crore. So the penalty is going to be the amount which is not transferred or 1 crore rupee, whichever is less. And every officer in default is going to be liable for that activity. So CSR is a huge area of practice available to us, especially for women members. We say POSH is a very good area of practice, CSR is a very good area of practice, ESG is a very good area of practice, business reporting, sustainability reporting. These are all very good, important area of practice available to us. And these are all new areas of practice. So we can get that early mover advantage if we get into those areas. Having said that, I will tell you, but I myself may not be doing it, but these are the things available to us to catch hold of. The CSR, whenever there is a CSR responsibility, the form CSR2 has to be filed. This has to be filed as an addendum to your AOC4. Till last year, it came in later. So last year they said after filing AOC4, it has to be filed it as a supplementary report. Now CSR2 is an addendum to our AOC4. That's going to be filed. Statutory form to be filed, MGT 14. Many cases, when you sit for due diligence, this MGT 4 filing or 14 filing might have been missed out. That has to be really taken care. There are some resolutions, board resolutions of public limited company, which needs to be filed. Every special resolution has to be filed, whether public, private, doesn't matter. And certain ordinary resolutions are also to be filed with MGT 14, especially in your private placement, borrowing, all these things. This MGT 14 has to be filed. Ensure that you get into the nuances of where all this MGT 14 is to be filed. And the problem is beyond a certain point in time, this form cannot be filed also. So we have to be extremely careful in ensuring that MGT 14 is filed. Then we have MGT 4, 5, and 6. MGT 4, 5, and 6 is filed under section 89. This is for declaration in respect of beneficial interest in any share. Let me give you a practical example. Say a company from Singapore wants to establish a wholly owned subsidiary in India. To establish a company, you need minimum 2 members. So the company could be 1 member, and the second member could be some nominee who has been nominated by that company, who holds the shares on behalf of the holding company. In such cases, the person who is holding the shares as a nominee is supposed to file, he or she is supposed to declare their interest in that particular share by form of declaration by the registered owner to the company within 30 days of entry in the register of members. So the company is incorporated, the member is a shareholder, he is a nominee of the company, he or she is supposed to give declaration in MGT4 within 30 days of becoming a member of the company. Now, the company who is the holding company has to give their declaration in MGT5 within 30 days of acquiring beneficial interest. So when MGT4 comes from the beneficial from the registered owner, MGT5 comes from the beneficial owner. Based on both the records, the company will file MGT6 within a certain time within ROC. And the entry of this beneficial shareholding has to be noted in the register of members in MGT1, post receipt of declaration. So this is something we cannot afford to miss out. So that needs to be monitored clearly. Second one is Ben 2. I say jokingly, it's Ben 10. In fact, when I was discussing with a company secretary friend, by slip of the tongue, it came as Ben 10. But then she said, it's Ben 10 only because this is applicable only when you have a holding beyond 10%. So this form Ben 2 is filed under section 90. It is very important to identify the significant beneficial owner of shares. So for example, a company has got a shareholder and that share, is a corporate. That company is held by another, by a corporate, and that corporate is held by somebody else. This Ben 2 form actually identifies, it is there to lift the corporate wheel and see who holds the ownership in the company. So this form Ben 2 is to be filed. It's an event-based form. It's to be filed within 90 days of receipt of Ben 1. The declaration comes in form Ben 1. And this is applicable to listed company, public company, and private limited company also. This is a chapter itself calls for an hour of deliberation and discussion. But let's sum it up for a bird's eye view of the chapter. So in BEN 2, what happens? Every company will shall take necessary steps to identify individual who's a significant beneficial holder in relation to the company. See, this significant beneficial owner is important for various reasons. Who are the actual members who are the shareholders? It could have relevance under FEMA. It could have relevance under, takeover code under SEBI. It could have relevance under so many things. I want to know who are the actual owners of the company. So the introduction of this section brings more clarity, casting a duty on the company to identify and report to the registrar. So it is not just on the owner, but it is on the company also to identify who is the significant beneficial owner. If the company fails to take necessary steps, then the company and every officer of the company in default shall be punishable with a fine, and which shall not be less than whatever is your monetary pecuniary liability. If some order is passed, then the company gets 1 year time to apply to the tribunal to appeal against the order passed by the registrar. So that's the significance of SBO, BEN 10. This is a chapter which calls for a detailed discussion because charge has got very significant public interest, because a bank or a financial institution is lending a loan based on certain amount of asset or the asset available for a mortgage. And if it's not reported and somebody else comes and gives a loan, is going to be a problem, especially with the mounting amount of NPAs in this country. Charge filing is a very, very important document. And nowadays, banks and financial institutions themselves ensures that once the loan is given, the charge is to be filed. So charge filing, CHT 1 is for the creation of new charge and modification in case of existing charge or other mini assets other than debenture. So when we file the charge, the certificate of registration is given in CHT 2. If there is any modification, it is filed in CHT 3. And if it is fully satisfied, the payment or satisfaction is reported in CHT 4. And certificate of registration of satisfaction of charge comes in CHT 5. And notice of appointment or cessation of a receiver or a manager is given in form CHT 6. The register of charges is made under CHT 7. When you are doing audit, ensure that you spend some time in reading the CHT 7 register. Ensure that the data there is matching with what is there in the loan records, is matching with what is reported in Schedule 3 and what is we are going to report under CARO. Let's put some time there and understand that, because here the responsibility is cast on us significantly. Then CHT 8 is for application to central government for extension of time for filing particulars or modification of charge or rectification of any omission or misstatement in the charges. CHT 9 is for creation of new charge or modification of the existing charge for debenture. So we have said section 77, 78, 79 and section 384 and rule 3(1) of Companies Act totally governs this entire charge. It's even in 1956 Act, this charge was a very, very important area for checking practice and things like that. So charge, we all understand charge means charge in the interest or lien in the creator on the property or assets of the company or on its undertakings, and it includes a mortgage. Company shall file particulars of charge within 30 days of execution of instrument creating or modifying charges. So I've just said satisfaction is filed in form of CHT 4. Creation of new charge, I already said for debentures, it is filed under CHT 9. And CHT 9 is required to be filed pursuant to section 71(3), 77, 78, and 79 and 384 I've just mentioned. Again, it is 30 days. Every charge is created to be filed with the concerned ROC. Now the last slide. And this slide speaks in volumes about our requirement or our understanding of Companies Act in terms of our audit, in terms of our lapses, in terms of our gaps in our knowledge. Schedule 3 formats. It has undergone change this year. The balance sheet ending 31 March 22, we all struggle to grapple with the changes. Rounding off is compulsory, which is no more an optional. Declaration by the management on properties which are not held in the name of the company, charges which are not registered within time, where loans are taken and diverted for various other purpose. Declaration was there. Many declarations were there under Schedule 3 format. Huge area of knowledge to be gathered there. First year, we might have afford to have missed something here and there, but I just told you, CSC has got 8 years to open our forms and check. Whatever the slips and gaps are going to come and haunt us day in and day out. Schedule 3, in terms of depreciation, the number of years specified, minimum years to be taken care. Notes to accounts, whatever the requirement which was asked in Schedule 3 needs to be provided there. Caro provisions, 21 clauses, so many changes, one deletion, so many new modification. All those Caro provisions have to be undergone or to be monitored. And those things can be done provided we look into all the statutory register, all these forms filed under MCA, and identify these slips and gaps in filing the documentation. Accounting standards applicability. If we miss out, that is again a violation. So whether Ind AS applies to us, the normal one applies to us. The Indian accounting standard applies to us. That needs to be done, and that needs to be checked. Secretarial standards for meeting, whether those are being followed. Too many things to grapple, to follow, to implement, and to comment upon. 1 hour won't be sufficient to discuss so many things in Companies Act. But having said that, the bird's eye view of all these requirements will make us think how much we are up to mark and how much miles we have to walk to get the understanding of the subject, and to explore an area of practice which is generally explored by only few professionals in our profession. I started with CSC. I'll end it with CSC, saying that before MCA forms were not picked up unless and until there was a specific need for inspection, investigation, or whatever. But now, from 18th March 21, the Administrative Governance Cells have established your CSC, Central Scrutiny Center. And this CSC will carry out scrutiny of e-forms which are filed under straight-through process. What is straight-through process? When you upload the form, it automatically gets recorded on the thing, and the data gets reflected in the MCA portal. Nobody scrutinizes those forms. But now those forms will be scrutinized by CSC, and if they find any problem, they can send their findings to the respective jurisdictional registrar of companies, and then the ROC can prosecute the defaulters and initiate action. And the beauty is they have got 8 years to open this form to find out if it is defective. When a form is found defective, that means we have to make good by filing a form afresh. That means we have to file it with additional fees. And this is to be filed within 30 days of defect being reported to us. No opportunity will be of resubmission or rectification of defect will be given in case of a STP form. In case of approval form, you will get 30 days to look into the form. Any other form other than STP, ROC will give us an opportunity to rectify and resubmit the form within 15 days of time with any fees or additional fees. So I just said ROC can open up to the CSC can open these forms up to 8 years. So we have somebody monitoring us, and all our non-filings, wrong filings, misdeclaration can be checked, questioned, and necessary actions being taken. So with this, I really thank the organizers for giving me this opportunity, and thank all of you for a patient hearing. Any questions, anything, we can connect online, offline, whichever mode. I'm available there. Thank you to the organizers for their action. Thank you so much.
On behalf of the Women Empowerment Committee of ICAI, I would like to sincerely thank you for your time, ma'am. You are truly an inspiration for all of us here. In fact, of how you're balancing so many things being single-handedly. Now, with your permission, if I may ask a few questions that have been asked by our participants.
Yeah.
One of the participants from Ms. Priyanka Verma has asked, saying that her client does not comply with Schedule 3 disclosures. She believes that because they pay low fees for such reporting, she is not able to understand how to explain to them. This is more an administrative question.
Yes.
But that's a very tricky situation for her, for any CA for that matter of fact.
Which is why she undergoes, all of us are undergoing. The requirement and the compliance casted on us is quite huge. The fees given by these people are quite, I won't even say peanuts. But having said that, when tomorrow there is a problem, registrar sends us a notice. In fact, I was just told a week or 15 days before, in one case, registrar has asked a professional saying that, have you gone through the minutes before certifying this form? We have scenarios wherein our members don't, our clients don't even maintain the register, their minutes book. In such cases, how are we going to do? We have no shortcut. Either we educate the client, sometimes we tell few clients, please, we will rather sit in peace, not do this work, and because we want a peaceful night's sleep. We cannot afford to take these kind of, but yes, I know what she is saying is a real challenge. All of us are undergoing, but this has to come over a period of time only by awareness. And we have to tell them these compounding orders. I will say for the academic sake, please go through the compounding orders issued. It is available in the MCA portal. I'm not saying threaten the client, but make them aware that, see, today you think, I think the Prime Minister made one comment in the Parliament or somewhere before saying, no, we are a country of jugaad people. So they all want shortcut. They wants to bring compliance culture in this country. And that you can see in any form filing in this country, whether it be GST, income tax or MCA. You have a deadline, you don't file, automatically a meter for late filing, penalty and things start. So we have to educate our client. I know many of my clients will say, you are asking me, others are not asking me such questions. I will say, please go to those others who doesn't ask you such questions. I cannot do this. Somewhere we all have to put our foot down and say, enough is enough. We cannot see, we are all there to help client, no doubt about it. Even at 12 o'clock in the night, if somebody calls, we are there to help them. But it cannot, see, we have only one certificate. Client has got multiple professionals. So this is what I say. I have to ensure that my certificate is in order. I need to take time. Having said that, she has raised a very pertinent question. This we have to ask in our community. We have to educate our clients. And some of us don't even aware what kind of risk is posed in front of us or behind us. That's where is our problem.
And the next question is by Ms. Purnima Vasavi from Andhra. She is asking about what kind of compliances is required by a venture capital fund, like a summary, a short note on it.
It depends. If you are in the Companies Act, you have to follow all the provisions of Companies Act, whatever is applicable based on the threshold. That's what I said. Corporate law compliance is interesting. At the same time, challenge. You have to see every section, which section will apply to what kind of threshold, whether you are having a capital of so-and-so wherein you fall under secretarial audit. So it has to be done. There is no single kit available. Apart from that, they might have FEMA compliance. They will have. Today, compliance has become a huge burden. Half the time, we don't even know there are such compliances as a professional. So that's where, so there is no one single checklist I can give it to you. She has to sit and see what is applicable to them, which all sections of Companies Act will apply, whether there is a AOC for CFS, if there is a loan, then whether the necessary provisions of 185, every section has to be minutely looked at and decided. You will have only a broad-based idea of checklist, but each and every section has to be dealt in detail. Yeah.
One Miss Vinita has from Faridabad has asked about the loan from unsecured loan will not be considered as a deposit. This was discussed by you. She has a question that unsecured loan from any person, or is there some conditions which make it ineligible?
Directors and their relatives, and if it's from shareholder up to that threshold, whatever is applicable. That's it.
Then another
banks and financial institutions. So you have to see whether you are under the exemption category where you can take the loan for a private limited company. For a public limited company, then it's a different thing altogether.
Ms. Veena J has asked about the requirement of an independent director for a private limited company. Is it a compulsory requirement or a voluntary?
It's not there. No, it is not there. Yeah.
Yeah. It's not. And one more question. This is from Ms. Purnima, who is asking us about the penalty for non-filing of MSME related forms.
The section says, if you file delayed, then there is additional fees, and beyond that, the penalty. You have to look into this because penalty itself is a chapter. Every section penalty, if you see. So every time I don't talk about penalty, I open the act and see what is the penalty. So you have to see in that section what is the penalty and late filing fee prescribed there. See, whenever you are reading Companies Act, read the act and go to the rules and combine and go to the register of fees and officers. Combine these three and you will get the answer. It becomes easy. Read the law, go to the the prescribed rules, and then from there take your conclusion. 99% of our question will be solved then and then. We don't need another professional to discuss also. Law read by rule. The rule is very self-explanatory in many cases.
Yes, ma'am. Ms. Pradena Kotari has requested you to throw light on Section 8 company-related compliance. Any important ones that we need to be careful about?
Yeah, Section 8 company, incidentally, tomorrow I have session in Aurangabad on the NPOs and NGOs. So, I also got my shocker because I am not incorporated a Section 8 company till date. You can't remunerate your members. It's there. You can't remunerate your members under a Section 8 company. Then, there are certain exemptions available to you. Those things are, in fact, I have a specific slide on it. I will share it with her on Section 8 companies. Otherwise, most of the provisions of Companies Act will apply to you unless and until there is an exemption over there. Number of directors, number of meetings. There are a lot of sections which give you the leeway. I'm not getting it often, but I have a chart which I can share it with them.
That would be wonderful, ma'am. With this, one last question, and I think we can call it.
Yeah.
This is from Ms. Vinita, who has asked about your thoughts on the government of India's decision for not accepting loans from individuals for a company.
I'm not the right person to comment on it. Having said that, we have to understand a lot of those changes which Government of India has got a thought process. When you look at the Schedule 3 and CARO, the kind of declarations they have asked. See, Government of India is also learning from their experience from IBC, how the companies have misused, diverted funds, how bank finances have been misused, how industrialists have been, diverting funds. So they have, and 99% they have got it correct. They have got the fundamental process right. So we may not know certain thought process why this is done, but the logic is very good. Anybody and everybody financing a company, now when we look at this NGOs funding, FCRA regulations, all these things have been coming with a thought process. So yes, I do agree. I work with a lot of private limited company when they are struggling to get money. In fact, I was told that IRD was supposed to come up with a policy wherein you don't have to give EMD or a performance bank guarantee, because you have to deposit money to get that guarantee, and these small companies don't have that. They were coming with a policy. It is at a policy level, but the insurance companies are not ready to roll out. So a lot of fundamental things which is happening. Similarly, money taken always we have to understand the definition of private limited company. We have the three things now: limits, restricts, and prohibits. So private limited company cannot take funding from anybody and everybody because it loses the very concept of public. So a very concept of private. So that's the reason. And there should be more and more avenues to finance MSMEs. So I think that's where her concern comes from, which many of us face. There is a liquidity crunch, and everybody asks for collateral. How do we get the collateral? And if we have a collateral, then why should I go for funding? I will manage it my own. So it's a chicken and egg situation. Yes, I agree with her, but it has come with some thought process from the government from their bad experiences.
And one last generic question on behalf of all of the participants. Which referencer for Companies Act do you think is very easy to understand and comprehend and work on with your experience? If you could just
I will tell you, go to MCA portal, go to the e-books, go to the law, and it has got the rules also. I used to refer physical books. Off late, I've stopped that. Okay, physical books, we have had the comfort of using it. I would say MCA portal is far more advanced than your GST portal or income tax portal also. The changes, amendments are updated there, and you can see them in colors. Green color for the latest amendment, red color for so-and-so. So I use the MCA portal for referring the Companies Act.
Ma'am, with this, we will wrap the questions as well. We'd like to sincerely thank you for your time and being so patient with all the questions. And we look forward to more of your sessions with us.
I'm really thankful to the organizers for inviting me for this session. Thank you so very much.
Rama ma'am, one more query. There is Palak ma'am would like to ask.
Vishnu Priya ma'am, can we take the query posted by CA Roshni Advani?
Just a minute. Yes, CA Roshni Advani had spoken about Section 8 company-related one, for which ma'am had said she'll share the PPT.
Yeah.
Okay, thank you so much.
Yeah.
Thank you, ma'am. Over to you, Ms. Palak. Thank you.
Okay. Good evening, my dear fellow members. I, CA Palak Vinod Tikmani, I am glad to be a part of this Sky High Symposium series for yet another time, and I would like to thank Preeti Madam for this opportunity. So taking this webinar forward, let me introduce our next speaker for the evening, CA Ramya R. Madam, who will be guiding us on the tax exemption for startups, a very riveting topic indeed. She is a practicing chartered accountant with Sengotian and Company Chartered Accountants. She is practicing as a private consultant operating in the fields of accounting, auditing, taxation, credit monitoring for banks, and management consultancy. She is also engaged in presenting papers at the various academic institutions. She has worked with Nest Technologies Limited as a finance executive and also with Reliance Infocom Limited as a management trainee. I now request CA Ramya Madam to begin with the session. Thank you.
Thank you, Palak. Thank you for the great introduction. Let me start the session.
Please, ma'am.
So first of all, I would like to thank Corona, which has brought us all from various corners of the country in a single platform. And, before Corona, we didn't pay much attention to all this, technology-induced meeting forums and all. So now with the, increasing need for, not actually physically being present in a place, we are taking advantage of this technology, and which I feel very happy to be part of. And the organizers of this program are doing a wonderful job. And my today's topic is, you had a very, power-packed session from Rama ma'am. Mine is going to be fairly simple. I wouldn't, take much of your time. The topic is about startups. So why do we need to discuss about startup is, I would like to give an insight for all members from Tier 2 cities, a way to put startups, the exemptions that are available for the startups in India, to put forth such ideas to your clients and take advantage of the situation. I'll get you through my presentation. One second. Yeah. See, we are going to see about tax exemptions for startups. I think I'm repeating it again. One second. History of startups India. Let's start discussing the history of startups India. See, basically, the skill for being an entrepreneur was there with multiple communities in India. Originally, all various communities were into various trade practices in India. There are many trading communities which have a history of having trade ties with many foreign countries. You can find many families having business ties with Burma, Sri Lanka, and so many other countries on the, like Indonesia, and so many other countries. So this started many years ago. There is even a saying in Tamil called "Thirai kadal odiyum thiraviyam thedu," which means even if you are to cross the sea or ocean, you go and look for wealth. In India, I'm seeing this the trend for startups in three waves. The first one came with the IT boom in 1990s. So before that, we were a kind of license raj, and we had so many problems with starting a unit. Indians didn't pay much attention to being entrepreneurs. So after this IT boom and having success of many of our Indian origin people in Silicon Valley, many new startups also started functioning from India. Then came, so this IT boom gave a little push to the income levels in India, so that consumerism was on the, moving on the higher side. So consumer-based industry like Flipkart, Uber, Swiggy, Zomato. So all this cater to some of your shopping needs or some of your needs for consumer articles. Now. So this kind of industry where technology was mixed with your consumerism, they became trendsetters. And then now the next surge, what I'm seeing now is the increase in R&D. India is becoming a hub for R&D, product development, process development, and we are having a core competency in the fields like artificial intelligence and all that. So now I'll talk about unicorns. Unicorns are those companies who have having started as a startup company with no particular background and have reached the 1 billion club. So such unicorns in India are about 107 in number, and we top the list at place 3. And the world list is, as of today, 1,312 companies which have been classified as unicorns. In India, DPIIT, it is Department of Trade Infrastructure Development Department under Ministry of Commerce. This is an organization for registration of startups. They have so far registered 77,000 startups. So this scheme started in the year 2016. Actually, 15 it was declared. The actual registration started only in the year 16. So far 77,000 business units have registered themselves with DPIIT. The rate of growth of startup is what is very interesting. In 2016-17, the number we added to the list of unicorns is only 1. But in 2021-22, it is 14 companies which have been added to the list of unicorns in the world. Even China had only 11 units which were added to this list this year. And the concentration of this startups in India is mostly at Bangalore, but we also see this NCR region, Delhi, the parts of Uttar Pradesh also now it is joining up the gang. So we see concentration of these startups in these areas. Now, many new unconventional sectors have also come into this fray, like NBFCs, cryptocurrency exchanges, cloud kitchens. You have an idea, you can start a startup, and you can form part of the startup, array. Also, the investment modalities. This is what I found was very, very interesting and very literally linked to our Indian mindset on investment. Like Indians don't like risk normally. So what we do is, if you see most of the major organization, they would have been formed with the capital whose seed would have come from within the family itself. The family would have provided the capital. So from that, it would have grown into multiple levels. So that kind of internal funding, risk-free funding modes are more suited for Indians, I guess. So now we have gone into crowdfunding. Crowdfunding, you must have heard of. Many movies are also being, taken with crowdfunding. Then there is one revenue-based financing model. Now there's a company called Zerodha. They have a scheme called rain setting or rain water or something. They provide seed capital, venture capital to new startups. The same kind of the hand holding and other stuff with regard to capital. So many such companies. Zerodha itself is a startup, so that is what it makes the whole thing interesting. And the popular segments in the startup industries can be found are technology coupled with anything, like you have fintech, finance and technology, food tech, food and technology. So this cloud kitchen and all forms part of this food tech. Edutech, you have Byju's and other tech companies which have education provided along with technology. The background of this startup scheme in India begins with our Honorable Prime Minister's announcement in his Independence Day address in 2015. The objective of this scheme was to provide a strong ecosystem for this startups and innovations to grow. And with this, employment would also be created. It's a byproduct of this. India had a very serious need for encouraging innovations because many of our people performed well outside India. Most of the companies, startups in Silicon Valley had people of Indian origin at its back. So why not such innovations and changes be done at home? That was the question that led to this idea of a startup. Along with this, there was also this Make in India scheme, which was making a wave. So this scheme helps the Make in India scheme, and we're all helpful to each other. The scheme provides for simplification of process of registration of startups in India and handholding. Handholding is you help them through the initial process of getting registered and getting things done, various registrations from various departments and all that. Then funding supports and incentive. The seed capital is also created under the scheme. So if you apply for the funding supports, those will be available to you. Incentives are also available depending upon the industry in which this unit performs, startup performs. And this category, our income, my focus today is to deal with income tax exemptions which are provided for startups. So that will be part of this incentive category. Then this scheme also provides for industry academia partnership as well as idea incubation. See, there is a vast divide between industry and the academia. there is a need for the academia to help the industry. You have, actually, basically in South India, there is a Rice Research Institute and also a Sugarcane Research Institute. So these institutes, many of us may not be aware of at all. These institutions, they provide on the ground support to the farmers on how, what variety of sugarcane can be grown for a particular type of soil. And they've even found a new strain of sugarcane, our very own sugarcane institute, which is at Coimbatore. They found a new strain of sugarcane, which is helpful for the farmers that can withstand drought and yield more sugar in the process. So that kind of partnership between the intelligentsia and the industry is required for the overall better performance. So this Department of Promotion of Industry and Internal Trade, this department, DPIIT, this department coordinates the entire scheme. They have a wonderful website. So anybody who wants to have any information on startups can have a look into their website, and you can get the required information. So to begin with, we'll see what a startup is. A startup is, they basically only up to 10 years of its incorporation, a company or a LLP or a partnership can be called a startup. So basically, this restricts entry of individuals and other constitutions as a startup. So startup can only be a company, LLP, or a partnership firm. And they are eligible to be called a startup only for a period of 10 years from their incorporation. And the turnover from their inception should not exceed 100 crore. So that means once they exceed the 100 crore turnover limit, they will no longer be a startup. Then the entity should be working towards innovation, development, or improvement of products or processes or services, or if it is a scalable model with a high potential for employment generation or wealth creation. See, this is basically, it must be a new idea. It must be some kind of innovation which has not been in existence before. That means you cannot actually put together a totally new or foreign thing. The thing is a slight change in the way things are presented. When Uber or Ola came into play, transportation was already available, but it was only a change in how the public transportation operated. They used a technology to connect the service provider and the service user. So that kind of innovation is what the scheme is looking at. Again, there is a proviso to this definition which says it should not have been formed by splitting or reconstruction of an existing entity. That means you cannot serve an old wine in a new container. So this definition is by the Gazette Notification number 127E dated 19/2/2019. So this Gazette notification gives all details of what a startup is, what is the turnover limit and everything. So what are the exemptions available for startups under Income Tax Act? The first and foremost is Section 80 IAC. Okay, Section 80 IAC is a comprehensive exemption that is available for startups. So what is the exemption? What is the kind of exemption we get from the Section 80 IAC? So we get 100% deduction of income earned by a startup for a period of 3 years in a block of 7 years. So once you are registered as a eligible startup under this with the DPIT, what you do is you register yourself with the CBDT. There is a prescribed form for this purpose. You have to register with CBDT also, income tax also. So once you are registered with them, you can apply for exemption. The registration with the income tax itself is application for the exemption. So after that, you're given a choice to select the 3 years in which you will claim the exemption. Okay, so the companies that are incorporated after 1/4/2016 will only be eligible for this exemption. And the companies which are incorporated till 31/3/2023, have been made eligible for getting exemption under this section. This is a sunset class. Initially, it was only till 2019, I guess. So later on, with each budget, the the deadline for getting the exemption under this section has been extended. So also with this budget 2022. Okay. So there is a technical clause here where a startup is using a second-hand machinery. The Act says the same will be considered as new if it was used out of India or if it is less than 20% of the total plant and machinery used in the business. See, this class is significant to prove that you are not forming this company by splitting or reconstructing an old company. So if you're splitting and reconstructing an old company, then you'll be using their own assets, the old company's assets. So in that case, in order to distinguish yourself as a new company, all your assets must have been new. Or if it is second hand, that must not have been used in India at all. So in that case, it will be eligible for deduction under this section. So these are the basics of exemption under section 80 IAC. Okay. So this is one wide section. So the total income itself is exempted so that these startups will not have any burden of tax in the initial year of their establishment. So next are the other exemptions are indirect exemptions. They're not as straight as this. Any startup will get exemption under 80 IAC on application. Right. Before I come into this, I will give you a insight into registration with DPIIT. DPIIT has a very comprehensive portal for registration of startups. There you have to make an application along with the basic data such as PAN of the company, the memorandum, articles, other registration data, along with the activities into which the company is into operation. Actually, you will have to submit last 3 years ITR also, but if the company is incorporated after 2017, that need has been relaxed. So you have to submit all relevant registration data, statutory constitutional data. And apart from that, you will also have to give details on how innovative is your idea and how unique your product or process or services and how it is going to lead to employment generation. So all those kind of data has to be provided. Once the authority is satisfied that this organization is indeed into becoming an innovative startup, then they will give you a certificate saying that you are a startup. So that is the process behind that. And then you have section 56 subclause 2 7B. So this section basically section 56 subclause 2 7B is to tax the amount of consideration received by a company. See, a company receives consideration for sale of its shares in excess of the face value of the share. So this company is a company in which public are not substantially interested. So in such a case, if they're receiving consideration which is more than the face value, then that excess amount will be taken to the income of the company as income from other sources. That is what section 56 subclause 2 says. But startups are exempted from this section provided the investment they receive is not made in a residential house. See, basically, they're listing some of the investments which are other than stock in trade. So that is, if the investment is made in these kind of assets and if it is a stock in trade, then also exemption is available. It's a kind of double negative kind of thing. See, you are investing in a building, then building which is a residential house, then you will not be getting the startup exemption. But if that building is rented by you or it is held as a stock in trade, then this exemption is allowed. If it is a motor vehicle or other mode of transport whose value exceeds 10 lakhs, then you will not be given exemption. But if that motor vehicle is held as a stock in trade, you will be given an exemption. Same thing with jewelry other than traded stock. So the maximum exemption given under this section is 25 crore. That is, you are buying shares of a startup company at a price which is much above the face value of those shares. And the money from that sale is used for purchase of a building, motor vehicle, jewelry, and all. Then you will not be getting the startup exemption. But if those building, vehicle, or jewelry is part of your stock in trade, then you will still get the exemption. Generally, you are getting the exemption for investment in startup activity, but these are the exemption. Hope I made things clear. Then there is one relaxation of section 79. Section 79 says that it is regarding the beneficial ownership of the company. So if the beneficial ownership of the company has changed in the period wherein the loss has been incurred to the period in which the loss is set off, then the company cannot claim the set off of loss. So that is the original section. That is, I'll repeat. You cannot set off a loss of a company in a year if at least 51% of the shareholders of the company who were the shareholders at the time of incurring the loss are still the shareholders. So if this condition is not satisfied, set off of losses will not be allowed. So this condition has been relaxed for a startup. This is to ease the possibility of doing business for startups. So on the whole, government is keen on providing end-to-end support to startups. So what I basically want to convey is we have to look into possibilities wherein we can position our clients to get benefits out of these sections. So where there is a possibility of our clients taking advantage of this governmental policy. So I think I've completed most of the exemptions. There is one more. There is exemption under section 54GB. This section 54GB provides a exemption against long-term capital gain which arises on residential property. So this exemption is available only to individuals and or a HUF. So if an individual or a HUF has a long-term capital gain on sale of residential property, then he gets an exemption if the amount is invested in MSMEs. So now this section has extended the investment in shares of startups also as part of eligible investment. So this investment has to be made before the due date for filing the returns. The investee company, the startup in which the investment has been made, they have to use the amount that has been invested for purchase of a new asset within 1 year of the subscription of shares. So the maximum amount that can be invested under this scheme is rupees 50 lakhs. So the investee company also cannot transfer the said assets for another 5 years. So once they do not comply all these conditions, that is, they do not purchase a new asset within 1 year, or they transfer the purchased asset within 5 years, they will lose the exemption. Okay. Then the usual conditions of capital gains account scheme. That is, if you're not able to invest within the time limit provided, then you can invest the amount in capital gains account scheme and then later on invest in the shares of the startup. So these schemes typically boost up the capital availability, provides encouragement for people to invest in startups. So if likely the situation could be, see, a person wants to start a startup company. he has his own property. He'll sell some that property and invests in the startup. So in that typical situation, he will not be burdened with the capital gain on sale of his property, which is necessary to seed the capital of the startup. So he gains an exemption. So he is encouraged to get into this activity. So then that company, this conditions ensure that the amount invested in the company is used just for the purpose of the company and not for anything else. So with this, I think I've covered most of the exemptions that are available. I'm open for questions now. Palak, ma'am.
Yes, ma'am.
I've just concluded my topic. If
Yes,
there are any
ma'am.
questions, we can proceed with that.
I request CA Poonam Pathak to raise the questions.
Good evening, everyone. Myself, CA Poonam Pathak, committee member, Navi Mumbai branch. And first of all, I want to thank Women Empowerment Committee of ICI for giving me this opportunity. So, ma'am, first, can we take questions on startups?
Yeah.
Okay, so we have received a lot of questions on startups and as well as on companies also. So there is one participant, Minus, is asking MSME benefit for tax.
See, basically today's topic was startups which are registered with TPIIT as startup. So that would be a topic for another day, I guess. That's a huge topic which we need to cover in full.
Okay, so we can cover this later.
Yeah.
And ma'am, lot of participants are asking for PPT also. Can we get PPT?
Yes, sure. We'll share that.
Yes, ma'am. And one of our client is into pharmacy trading, nothing innovative, but not sure how he has got DPIT startup certificate.
Maybe they would have been, I'm just guessing, they must have a platform sale online, or a door-to-door selling, or some kind of thing which makes them innovative.
Okay, so because of that, maybe they got this.
Yeah, that is the idea behind it. See, if you're a grocery store owner and you start a program with some 100 members in the locality, and you agree to deliver fresh vegetable, fresh grocery every day for a particular value, then that is also an innovative idea, no? That kind of thing.
Yes. And ma'am, there is one participant, Poonam, she is asking, I am not clear on the who will qualify on the startups for the startup.
Okay. See, I'll go through that again. A startup is someone who is new to the industry. Okay, so that should not be older than 10 years into the industry. And startup is someone who is small in size, small in the level of operation. So their turnover should not exceed 100 crores. And then they should be working towards some kind of innovation development or some process improvement service. So all kind of segments are included in this, provided there is a kind of innovation or something new to it, a new edge to it. And it is a scalable model with the potential for employment generation. That is, many new people can learn from that and they can start their own business with that. So if that kind of a idea is presented as a business idea, then that will be eligible for being a startup. And it should not be formed by splitting or reconstruction of an existing entity. So I'll give you a few examples of startups. This Zero Dha, which I was discussing earlier, they are into share broking. And they are a startup because they took this, share broking into the virtual form. So they have a good app developed for the specific purpose. They have a separate app for SIPs. They have a separate app for trading, which was much more easier to use than the previously available applications. So because of that, they were granted the startup status. Hope I made things clear.
Yes, ma'am. And ma'am, the earlier question asked like how client got DPIT certificates. The Shruti is again asking, yes, they do door-to-door service. That's right. But do the department decide what is innovative? Please share your inputs.
It is actually discretionary. See, it is a quite wide-ranging thing. It differs from person to person who sits judge on the application. So it's quite a discretionary thing which is given on the DPIIT, but they are in a very kind of lenient mind frame only. So any slight innovative thing is also encouraged. They do not. The government's policy is to encourage innovation as well as growth of industry. So any small innovation which you can show should also help. Mostly technology related innovation is what getting importance.
Yes, ma'am. Ma'am, another participant, Veena, is asking, can you refer any book for startups?
The whole internet is your book, open to you. This DPIIT website is more comprehensive. And when I was looking for material on my presentation today, there were multiple varying versions. So that I found was disturbing because, being chartered accountants, we can check the original act. So for the income tax related provisions, you can check the Income Tax Act itself. And for the other aspects of the regular processing of things at DPIIT, the website of DPIIT itself should suffice because there are so many varying versions available on the internet.
Thank you, ma'am. Ma'am, another participant, Deepti Jain, is asking what points to be considered for registration as an edutech startup?
Education?
Startups, edutech.
What? I didn't get you. What startup?
Ma'am, like online education portal.
Oh, education, edutech. Okay. Okay. The same thing, there is no difference from industry to industry. The process is all the same. The business model has to be developed by the business person. So with that, you have to give a presentation on what your business plan is, how innovative it is. The application itself provides a method of giving inputs on what all innovative activities there is a questionnaire actually on how innovative your thing is, what products you provide, what service you provide, and all that. And there is another descriptive area where you can provide other details which you can give them to support your idea. I mean, other details of how innovative, how your organization is eligible to be called a startup and all that in the application itself. The application is very easy to fill in and self-explanatory. It's not a very complicated thing. It's a very simple thing. Any professional like us will be able to help the client with this.
Ma'am, can we have a slideshow of the PPT, please?
Can I ask another question?
Yeah, sure.
Yeah, ma'am. So another participant is asking what is the scope for CAs in startups?
See, you can suggest your clients, encourage them to start into invest. To begin startups. One second, Ma. You asked for a slideshow. You want me to show all these slides, one after other?
Yes, ma'am, please. For the benefit of the members.
Yeah. The other question was the role of chartered accountants in this field. See, the thing is, you can see when you see an idea which is worthy of being a startup, you can advise your clients saying that they will get more tax benefit being in the startup category, and you can help them with registration as DPIT and other DPIT and income tax, and wherever possible, even in getting loans and all, they get a better preference. So once you do this kind of service to your client, your value is added in that. So you also help the nation building.
Yes, ma'am.
See, the thing is, I am from Erode. Here, there is a traditional mindset on what business people do. Like, textile is the major industry, turmeric is the secondary industry. And it's a kind of agro-based environment, agro-based industrial development kind of environment. Here, people refuse to take much risk, and they were very conservative on the business ideas. So even this conservative business ideas can be put in modern platforms. So now slowly they are coming out of that, and they are making their own business on the, they're buying from very far off on the online portals, and now they're selling on the online portal. I have a client who is making this, what do you call? It's made of multi-grain powder for general health, nutritional powder for general health. It's made from various grains that are available in this region. So she makes, she's got a FSSAI certificate. She has got a trademark. All this company is actually very small. It functions in a house, and she's selling on Amazon. So these kind of entities need encouragement from professionals like us. So they need to be told what are the advantage of being registered as a startup and how they can benefit from being a startup.
Thank you, ma'am. Ma'am, one more question is it compulsory to be partnership or private limited company for startup?
Yes, ma'am. Yes. Yeah, only companies, LLPs, or partnership are allowed to be registered as startups. In Income Tax Act, even partnerships are left out. Only companies and LLPs are eligible for 80 IAC. So better to form them as company or LLP.
Okay, ma'am. We are getting a lot of questions regarding startup. So there is one more question. If a company goes for public issue, will it cease to be a
public issue? See, actually, there is nothing. See, these exemptions are lost. That is, Section 52 says a company in which public are not substantially interested. Again, the 100 crore limit, we'll have to see if that will be affected. So all these things are to be considered. So just being public limited does not make them ineligible for being a startup.
Okay, ma'am. And ma'am, they are asking, there is any time limit for registration as a startup?
There is actually no time limit. This scheme itself started in 2015. Announcement was made in 2015. The actual beginning of the scheme procedural beginning was in 2016-17. So companies that have which have registered themselves under the scheme would not have been more than 4 to 5 years old now. So even after you start, you can register yourself as a startup. But once you register, you'll be eligible for a startup status only for 10 years.
And when there is one compliment from Beena ji, she is saying that both sessions are wonderful. Thanks a lot, speaker and team WMEC.
It was actually wonderful being part of this session, and it was an opportunity for me also to look into this, this topic, which is very much essential for practitioners like us. It has been great seeing all from various parts of the country. Thank you, Women's Empowerment Committee.
Ma'am, there is one more question that, ma'am, can manufacture of automobiles, spares, cover under startup?
Automobiles
can register under startups.
But they'll have to show some kind of innovation there. So if they are having a new kind of method than the previous one, how unique is their process? Or if it is an electric vehicle, so that itself is an innovative idea in these days now. So electric vehicle which has got a lasting battery, it is all in your creativity, how you express it, some idea as new. See, selling peanuts in a new kind of container can also be sold as a new idea. You can say if you click a small button there, it directly goes into your mouth, you can say that. It's an innovative way of presenting your product or process or anything. Anything can be presented as an innovative thing, according to me.
All the questions of startups has been covered. Thank you so much, ma'am, for answering. And I hope all the question has been answered. Any question left or any participant has any question, please put into the chat box. So we have 2 minutes and then we will move for the complete set.
Yes, Poonam?
Yes, ma'am. So, ma'am, there is one question from Priyanka Verma ji. She is asking, a foreign company is 99% shareholder in Indian company. The foreign company has a nominee representative apart from MGT4. So this is only question.
Yeah, the nominee has to file if they are not holding in their individual capacity. If you call it as 100% subsidiary, then he will be a nominee. If 99% is held and 1% is not held as a nominee, and the investment is coming from them, then you don't have to file. So you have to look at the facts of the scenario and then decide whether MGT 4, 5, and 6 have to be filed. Yeah.
Yes, ma'am. Ma'am, there is one question. Companies Act 2013 compliances to be fulfilled by a venture capital fund.
Yes, if you're incorporated as a limited company, all the compliances automatically follow. Na? If you're not a limited company, then the act itself doesn't apply to you. Correct?
Yes, ma'am. So, ma'am, Kavita ji is asking, issue of shares and premium impact capital gain on company.
See, again, as Ramya ma'am said, if it's a startup, if you're a startup, then it will not be questioned as income in the hands of the company. They are exempted. Otherwise, yes, there has to be a valuation report. If the valuation report, the intrinsic value was so and so, then there will not be capital gains. If the valuation is, say, 100 or 10, and you are issuing at 100, naturally that 90 rupees difference will be treated as income from other sources. It will be taxed. So you have to look at the valuation report, and you have to look at the what do you call? Are you a startup who is eligible for that exemption?
Okay, thank you so much. One participant, Priyanka Verma ji, is asking, one of my clients got their audit done, but the auditor did not comply with Schedule 3 disclosure. Client does not understand severness of non-compliances. Because
this question I have answered in detail. That question has already been picked up. I said, yes, it's a evil all of us are facing. We have to educate our client. That question is being picked up. I've already answered that question. Yeah.
Okay, ma'am. Yeah. And what if the share capital is brought in cash? There are few companies who do that.
It should not be, in our opinion, no, because you have to look at the implications of Companies Act also, Income Tax Act also. Capital, we don't suggest anybody to bring it in cash. In the sense, little cash. Otherwise, consideration other than cash and cash is a different thing. But you can't bring it in cash. You don't bring it in cash.
Okay.
Are you talking about a scenario where the shares are issued for consideration in cash, which means that it is not in kind? So probably I bring in a plant and machinery. So the allotment is done in kind of
Is there any specific section stopping us from not getting the share capital in cash?
No, I will not suggest. Yeah.
Okay, ma'am. Then what's the disclosure requirement of foreign director who is director in a foreign company but no other Indian company?
No other?
Indian company, only director in foreign company.
The company is not incorporated in India, right?
Yes, so director is holding directorship in foreign companies.
Yeah,
and
so it doesn't fall into the requirement of Companies Act. No, Companies Act talks about companies which are registered here under the Companies Act. Here is an individual who is a director in a foreign company. So we are not governed by the Companies Act here at all.
Yes.
Yeah.
Yeah, ma'am. Independent director is mandatory to be appointed for private limited company.
No, that question also answered. Yes, not requirement, not required.
Is nil form MSME 1?
Nil form of MSME 1 is not required. Only when there is a MSME due more than 45 days, that has to be reported. Nil reporting is not required.
Okay, ma'am. Then what is the event for MBT 14 filing?
It's a beautiful section. You have to go see. In some companies, for the board resolution, you have to file. In special resolution, every case it has to be filed. Then in some contracts also it has to be filed. So it is event-based, company-based. You have to look into the section in detail. It cannot be one general answer.
Okay, ma'am. Ma'am, fixed asset registers are required to be statutorily maintained.
Which one? Sorry?
Fixed asset registers.
Absolutely. Your Companies Act says, in fact, CARO 0.1 talks about, is the assets are maintained, the assets in the fixed register are physically available. Fixed asset register is mandatory. There is no shortcut to that.
Okay, ma'am. And ma'am, what is the definition of manager for filing MR1?
MR1, if you are just a minute. MR1 is for which particular thing? I just told you. Just a second. Give me a second. Manager, key managerial person, right? MR1. I just said that. In that case, it's for applicable for listed company and public limited company.
Okay, ma'am. And ma'am, what is the penalty for non-filing of MSME form?
This says no. Late filing, the late filing charges will be applicable. If there is a compounding, the compounding fees will be applicable. And if nobody catches you, you are on a sweet ride.
Yes, ma'am. Ma'am, participant is asking like unsecured loan will not be considered as deposit.
I just answered that question. Has also been answered, Poonam. Yeah.
Okay, ma'am.
Yeah.
Can you please guide us on Section 8 company compliance special attention point?
Yeah, in fact, I was about to say, I just missed two important things. Section 8 companies cannot declare dividends. Their capital cannot be repaid. They cannot do bonus allocation. Section 8 companies are meant to be a charitable institution or for the furtherance of public image. So Section 8 companies are your erstwhile trust and societies with corporate governance and stringent requirement. The members cannot be remunerated. So these are the specialities of Section 8 companies.
How Section 8 company appoint treasurer as there are only 4 designations in DIR 12?
It's not required also, no? You mean treasurer, right? It's not required also, no? See, it talks about the erstwhile trustees who are called directors here.
Okay, ma'am. Ma'am, what was the thought of the GOI for not accepting the loan from individual?
I answered that question. I don't know the answer. So I just beat around the bush and gave something. What is their thought process? Even I don't know. I said all their thought process comes from their past experience. So they would have had some very compelling reasons to bring it. Maybe it is beyond my comprehension, at least at this point in time, to find out. But otherwise, when you see, I just draw a parallel. Schedule 3 requirement, your CARO reporting, GST e-invoicing, input restriction, all are coming with a thought process. And those thought process, ultimately, it boils down to business ethics, integrity, and more of governance and less of government.
Yes, ma'am. Ma'am, one participant is asking, will salary payable to working director unpaid for more than 1 year, will it be included as loan for DPT3 form?
No, it is the salary provision you're going to make. No? So it is a liability, and this is not treated because you don't have funds to pay, or you might have some other reasons. So this is not a loan for sure. Yeah.
Okay, ma'am. Best referencer for Companies Act.
I told MCA portal is the best portal I have seen. In fact, it comes with colors. I just said green color for the latest amendment, red for one amendment before that. Even your GST and income tax portal is also not updated. MCA portal is beautiful. MCA Act is beautiful. I will not say portal. People will kill me the way LLP portal and companies portal has troubled us in the last few months. The Act, the e-book in MCA portal is fantastic.
Thank you, ma'am. There is one compliment from participant. Her name is Rama. She is saying that very informative. Can we get copy of this presentation?
Yeah, definitely. I have already mailed to the organizer. You can take it. No problem at all. Thank you.
Okay, so I shares. There is one more question. Shares are already invested in cash long back into the company. I think, ma'am, this is the same question related to earlier.
See, if you have done something, I told you in CSC slide also, what wrong has been done, it is done. Tomorrow, if you want to come out safely today, go for a compounding. Otherwise, keep quiet and wait.
I think that is only the way we left.
There's no other option available. Yeah.
Yeah. Ma'am, after 10-year completion, the company will not qualify as a startup. So this is related to ma'am. And this is as auditor, what is related party disclosure for nominee?
Sorry, what was the question?
Ma'am, she is asking, as an auditor, what is related party disclosure for nominee?
Nominee related party, you mean to say a nominee director?
Yes, he is asking, as an auditor, what is related party disclosure?
No, actually, as an auditor, I have to look at the disclosures made by the directors, which all the concerns in which they are interested. Whether they might be a director in that company, they might have a substantial shareholding in the company, they could be relatives sitting on the board, there could be relatives holding shares on that company, there could be proprietary firms in which the company is dealing, on which the director is a promoter. Because all these things, end of the day, in Schedule 3 reporting, you have to disclose. Your shareholders should know. I say 2013 companies is all about corporate governance. So, and I just mentioned in one slide, in a related party transaction, in case of a private limited company, the director can participate in decision making after disclosing the fact. If he or she doesn't disclose, in a public limited company, you don't even take part in the decision making. You don't be a part to the voting of that particular transaction. But in a private company, unless and until I disclose it and take part in it, if tomorrow it comes to the knowledge of the company and the shareholder, this is a related party transaction, those transactions are voidable at the option of the company. So that is the significance. Tomorrow they can rescind the contract, they could invalidate the contract. So it's voidable at the option of the company.
Yes, ma'am. So one more question, whether for claiming section 54 exemption, amount deposited in capital gain account scheme be withdrawn and used in MSME?
Startup. So that is what we are talking about. So it has to be withdrawn and invested in the startup.
Okay, ma'am. There is a few more questions relating to startup. She is asking whether after 10 years completion, the company will not qualify as a startup. Is this correct?
Correct.
Okay, ma'am. So we have answered all the questions and we got a lot of queries. And thank you to both the speakers for answering all the questions. Thank you so much. And we have with us ma'am also. Our vice chairperson has joined the session. Okay, so till then, there is any question from the participants? If anybody has any query. Ma'am, she's asking any reference or sheet for exemption for MSME available.
I'll check and get back on that.
Okay, ma'am. So whether ma'am is joining the session? Ma'am, give me 1 minute. I'm calling her.
Ranganayaki ma'am, we need to compliment you for a wonderful session.
Thank you very much. Your session was also equally, informative and interesting.
My topic was quite simple, so I was lucky today.
The topic is too huge, it's very difficult to cover in 1 hour, that's the challenge. But though I just try to just touch upon
each point has got some kind of significance, some kind of backwork, or some kind of thought process. That was
So
nice.
I just had discussion with ma'am, and she asked to pass on the message that she is very much thankful to all the participants and speakers for this wonderful session. And due to some other commitments, she is not able to join. So thank you so much.
Thank you very much for giving us the opportunity. It's our pleasure.
Yes, ma'am. I request technical person to please conclude the session.